do markets have it right in these assertive moves to price in an easier Fed, better earnings, and a friendlier policy backdrop? Let's ask Rick Rieder. He's BlackRock's CIO of Global Fixed Income and head of its global allocation team. Rick, good to see you.
Thanks for having me. Appreciate it.
So take us back to, I guess let's start with the CPI report. And then, of course, that we had the bond market move and this rotation in stocks. And then, of course, the events over the weekend. People feel like we have a fix perhaps on the probabilities for November. But where does that leave you in terms of, are we on this path to a soft landing, and what's the next move for the Fed?
So there's a lot there. I would say, first thing I'd say, listen, CPI report was an indication of we are moving to a place where inflation is coming down. And I think Chair Powell said it today on the interview. We are at a place that is much more like 2019, much closer to normalcy. You're getting a bunch of the readings. Core PCE is coming down, still around 2.6. But if you look at the 3 months, 6 months moving average, you get pretty comfortable with inflation is durably lower. So I think that is real. Second thing, growth is moderating. I know I said it on the show last time, I'll say it again. I don't believe people come out hard landing like this can accelerate. Service economy doesn't really go into deep recessions. I think we're slowing. We've got real GDP this year at around 1.5, just under 1.5. That seems about right to me with inflation that's normalizing. And I think you can pull it all back and say, okay, if we're in normal condition with the trend moving more towards moderation, the 5 3/8 funds rate is not the right funds rate. And I think what Chair Powell said today, they've gotten the confidence over the last 3 months, have gotten the confidence that we are closer to normalcy. We're not overheating. They could start cutting rates. Will they cut in July or this month? I think the odds are low. It's not impossible. You've gotten some data that would allow you to do it. I would do it. But my sense is he's probably going to listen to the committee. He was pretty clear today about, I'm not telling you where we're leaning. And I think it's also, Chair Powell is very much, he listens to consensus. He likes to build consensus. He's going to talk with the group, and I think they'll set up for a September cut.
And then, I guess, what are the stakes involved, whether it's July, September, 2 or 3? Is it just about the direction we're moving, or do you think the economy and the markets kind of need the cuts either sooner or later, or just more of them?
So first of all, for us, it's a big deal because there are trades, especially you could have on July versus September. So you end up looking at those things. For the broad economy, moving 25 basis points, there is no impact. The trend is real, and the trend, in my sense, is the market today is pricing, and we're pricing in almost 7 cuts through the end of next year. Markets have done an awful lot to price it in. My sense is you get a little less than that if all else being equal, but we're going to learn a lot, as you said. Post-November, we're going to learn a lot about inflation. We're going to learn a lot about trade, and so those things are going to be clear. But right now, rates market is pricing in an awful lot of cuts, and I would say most of the return in fixed income is clipping coupon, is actually generating income, versus, gosh, we're going to get a big rates move from here.
Yeah, and I guess if you look at the equity move as well, I mean, it's a little bit complicated in terms of discerning what exactly we're reacting to. Obviously, the relationship was stretched, right? You had Magnificent Seven over everything else for so long, so there was room for this catch-up trade. And then you get yields going lower. We think we're getting a Fed rate cut. That playbook gets kicked in. And then, of course, if, in fact, the market's right and there's a higher probability of either Republican sweep or just another President Trump administration, does all that make sense as you line it up?
So first of all, I think the technicals drive the markets more than people realize. I think there's not enough stocks for sale that you get these concentration, particularly in the areas where you think there's real earnings growth, and they buy back, those Magnificent Seven buy back a huge amount of stock. So the technicals, part of what we've argued on the show before, if you create those sort of earnings with 18, 90% return on equity that builds book value of stocks, plus the equity buyback, that's a pretty darn good technical. I think that technical is still in place today until you change the earnings paradigm, and the rate paradigm is going to be pretty consistent. My sense is we keep grinding higher. The thing that's amazing to me is equity volatility is so low, and day to day, you get moves like today, like Friday, like Thursday. We get 50-point moves in the S&P 500. So one of the gifts, I know I said on the show last time, is just buy. You can use call options. You can use call spreads. You can stay long equities with some real protection because of how cheap volatility is.